In recent years, the global sports world, especially football, has witnessed a strange financial phenomenon. Major clubs are no longer just competing for trophies, but are becoming highly sought-after financial assets on the global market. Massive acquisitions, such as Todd Boehly's takeover of Chelsea or the influx of Middle Eastern investment into clubs like Newcastle and Manchester City, demonstrate that valuations in sports are now driven not just by goals scored, but by commercial potential, broadcasting rights, social media presence, and cultural influence. However, amidst this valuation frenzy, one legendary name threatens to burst the global bubble: FC Barcelona. Barcelona is no stranger to the world. It once stood as a model of sustainable development, boasting the famed La Masia Academy, mesmerizing tiki-taka football, and iconic players like Messi, Xavi, and Iniesta. But behind the spotlight now lies a story filled with anxiety. Many experts are warning that Barcelona may soon become the first symbol of financial misvaluation in modern sports, where brand reputation no longer reflects actual financial health. The signing of Robert Lewandowski, one of the world's best strikers, was seen as a move to maintain value and prestige, but the real issue lies far deeper than one individual or on-field performance. The looming risks stem from within. A flawed governance model, aggressive financial strategies, and an over-reliance on so-called economic levers could make Barcelona the first major club to collapse in a market inflated by hype. One of the most concerning aspects is how Barcelona has used financial levers to rescue its short-term budget. The club has sold off large portions of future broadcasting rights, a long-term and stable revenue source, in exchange for immediate cash. In the short run, this allowed them to register players, pay wages, and maintain a competitive squad. But in the long run, this is a dangerous trade-off, cutting off future financial stability to patch up present-day problems. Losing control over future revenue makes Barcelona vulnerable to unexpected shocks, such as economic downturns, media crises, or changes in UEFA's financial regulations. What's worrying is that this model isn't the result of ignorance, but a chain of strategic decisions that amount to a gamble. Barcelona believed it could maintain global relevance by borrowing from the future, counting on its massive fan base, international commercial revenue, and return to the Champions League to make up for the losses. But reality proved far less optimistic. Post-COVID revenue recovery has been sluggish. Early exits from European competitions have cost the club tens of millions in prize money. Meanwhile, player wages remain high. Many contracts signed during the club's golden era have become burdens. Moreover, Barcelona's ownership structure as a member-owned club, socio-owned, makes it difficult to raise fresh capital. Unlike clubs owned by private investors or wealthy individuals, Barcelona cannot easily issue shares or sell a stake in the club to generate liquidity. This has forced the leadership to become creative, but also pushed them into risky territory, such as selling 25 years' worth of broadcasting rights to outside financial firms. It's akin to mortgaging your house to pay for everyday expenses, leaving long-term control severely weakened. Global investors are starting to realize that the current valuation model of football clubs, which often hinges on fan base growth, TV rights, and global appeal, may be overstating real earning potential. Barcelona is a textbook example. Social media followers can't pay salaries, and brand value can't replace steady matchday and broadcast revenue. While other clubs like Manchester United, Real Madrid, or Bayern Munich maintain financial discipline, Barcelona may become the first financial bubble to burst in this era of global sports inflation. Undeniably, Barcelona remains one of the strongest sports brands in the world. It has a global presence, cultural influence beyond football, and a loyal fan base. But the weakness of a giant brand is that it becomes a hostage of the expectations it creates. When sponsors, fans, and the media believe in eternal dominance, any sign of collapse causes a domino effect, eroding trust faster than any financial metric can capture. Barcelona is playing a dangerous game, using reputation as collateral and branding as a means to borrow against the future. From an economic standpoint, Barcelona is not just a football club. It is a case study in how traditional institutions struggle to survive in an era of hypervaluation. The question is, are legacy brands really worth what balance sheets suggest? Or are they sandcastles, easily swept away when the tide of reality rolls in. As global sports are increasingly shaped by financial players, private equity firms, multinational conglomerates, and even sovereign wealth funds, Barcelona shows us that not every team can play this high-stakes game without eventually paying the price. If Barcelona truly slides into financial decline, not necessarily bankruptcy, but a serious loss of confidence from the market, sponsors, and commercial partners, the consequences will extend far beyond one football club. First, La Liga, Spain's top football league, will suffer the most direct and severe shock. For over 2 decades, the global value of La Liga has been inseparable from the Real Madrid-Barcelona rivalry. Losing Barcelona as a media magnet and competitive icon would slash the league's broadcasting rights value. Imagine a season without a high-stakes El Clasico watched by millions around the world, or a Barcelona floundering in the race for a top 4 spot. That would be a nightmare for fans and a financial disaster for the league. Next comes the transfer market, where Barcelona has long served as a valuation anchor. The club's bold, expensive, and often symbolic signings, from Neymar to Griezmann to Lewandowski, don't just carry sporting weight, but help set the global standard for player pricing. If Barcelona can no longer compete financially, a large portion of the transfer market will feel the ripple effect. That also means mid-tier clubs, which rely on selling players to giants like Barca to survive, will lose a vital revenue stream. The entire European football ecosystem would undergo significant adjustment. Player prices may cool, but so will investor interest. Barcelona's potential collapse also raises red flags for global finance, which has increasingly treated sports as a promising investment sector. In recent years, private equity funds, sovereign wealth funds, and financial institutions have poured billions into sports, especially football, believing it offers stable, long-term cash flow through TV rights, sponsorships, and digital growth. Deals like CVC's multi-billion euro investments in Serie A and La Liga, or Silver Lake's stake in City Football Group, are based on assumptions of profitability and resilience. But if a global giant like Barcelona, with all its scale, reach, and fan loyalty, can spiral into crisis due to flawed assumptions about future revenue, are we being too optimistic about sports investing? One of the most dangerous consequences would be the loss of confidence in the financial model of sports itself. Much like the dot-com bubble of the early 2000s or the 2008 financial crisis, when markets realized that overvalued assets weren't truly profitable. When the bubble bursts, it's not just clubs that suffer. Shareholders, investors, broadcasters, and even secondary financial markets, like sports bond markets, could get pulled into the chaos. Barcelona, in its current state, has the potential to become the Lehman Brothers of the sports world if it fails to undergo a bold and comprehensive financial restructuring.